Sanjay Dutt joins us now. Let's connect with him. Sanjay, good morning. Thank you for joining us. Sanjay, on a routine day, I would have started with a market question, but I want to address this entire aspect of unlocking which some of the companies are doing, and you've been a bit advocatory of that. And in your experience, given what's happened to Jindal group of companies, do you think unlocking of businesses in this kind of a bull market is great news for minority shareholders?
I think irrespective of the bull market, these kind of things shouldn't be driven by really bull markets or bear markets. These should be focused business decisions, because it's absolute common sense that if you have a business which has a different DNA altogether and you've kind of put it as a division or strategic business unit, part of a consolidated entity, it doesn't make sense to have it there. And also when you incubated it and now it's reached a reasonable size where it itself can run a standalone balance sheet and is profitable, there is value in it, a substantial value in it, then of course it makes sense. So I would not like to connect it to the market really. I would want to look at it as a standalone business decision irrespective of the market. Yes, obviously in a bull market, you need excuses for, re-rating companies and kind of, analysts like us and research houses like us selling these kind of stories. But from a market, from a investor perspective, from a promoter perspective, these decisions should be irrespective of a bull market or not. And I think these are sensible decisions being taken, which make it easier to implement when the bull market is on, because the overall sentiment positive, so promoters inclined to kind of unlock value, and he also wants to see that he is getting the right value for what he is kind of taken out of the main company and streamlined into separate individual business companies having their own individual setup, which have grown within the main setup.
Okay. Now back to market, Sanjay. We saw, I won't use the word scary, but we saw deep fall last week, and it was excruciating for some of the leverage names and some of the momentum names. Do you think this bull market correction has come and gone, or given the way how earnings have disappointed, there is a lot of downside which is still open?
I don't think there's a lot of downside that's open. There may be marginal downside of 2% in the Nifty, which you can see anytime in a matter of 2-3 days or 4 days. But there was a substantial amount of froth in stocks where it was not really justified. The valuation bubble and the irrational exuberance. Pardon me for this phrase, which has been used to death, but that needed to basically get corrected, and that's exactly what we saw. If you look at some of the prices that we saw on Thursday, Friday, particularly on the Friday panic, when everything got kind of all the leverage names and all the places where there was a lot of speculative activity got slashed out. I think that kind of an activity will go on, and it's very healthy for the market, because you need to understand that now the bull market this time is going to be a quality market, in the sense that even if earnings haven't caught up with the prices, still the prices of companies which are good quality and which have the potential for earnings to turn in the next few quarters are the ones which would probably keep trading at a steep premium to the current earnings, with the expectation that the earnings is around the bend. So cut a long story short, 2-3% correction can happen anytime aggressively, particularly when froth builds up. A lot of speculative activity starts getting built up.
So Sanjay, what do you do as an investor right now, and where do you think the next trigger is going to come in from, and is it going to be only the Q2 earnings which are going to provide that next fillip to the market, or do you think at a time like right now it's more the geopolitical murmurs which are going to really dictate the market mood, not just for us but across the globe as well?
Of course, geopolitical implications do have an impact, but according to me and what I understand from people in Delhi is that over the next month or so we'll have a substantially large number of meaningful reforms and announcements coming from the government. Something big that I expect is that FDI and retail. There were some reports in the press of permitting FDI into construction, because construction and probably more easing out in real estate, because a large number of projects that are stuck because of companies stuck with the investors' money, etc., etc. So I think these kind of reforms which are needed right now would come in, so that one can sort out some of the sectors which are still in problem, particularly things like some real estate companies which have got into a mess, where small investors' money, small home buyers' money are stuck, but the projects need to be completed ultimately. So to facilitate all that, I think government is totally on the ball and is watching the situation, is actually looking for solutions. Like we've read a lot about what they were trying to do with telecom, going back and forth. So that's what I like about what's happening right now, and I think that's exactly what is going to drive the markets ahead. Government's decision, going sector by sector in a clerical manner, taking decisions. Yes, some of them do turn out to be not an optimal solution, like we could argue about the NCLT process that's going on, but at least we know that the government is in charge, government is taking decisions. And then another thing which I think is going to come in soon in the next fortnight or so, which may be a trigger for the markets, is probably a cabinet reshuffle, which is much needed. So if we see some good portfolio allocations given to performing ministers and shuffling here and there, that will again be some kind of a kicker for the market if things work out positively. International events, I think, would have an effect, but not as much as what we all are making it out to be.
Sanjay, are you buying the fear in pharma, or this is like a 2008 situation, 2000 kind of an IT situation where IT companies, when they got spooked because of that .com issue, it took them 3 or 4 years before they were able to come back?
I did make a wrong call in pharma, I think about a month or two back, and I thought that it was time to look at some like Sun Pharma and all, and from that time I think they were again down 20-30% probably. We all make mistakes, we all can't understand where is the bottom, at the same time like we can't understand where is the top. So that was one of those calls that I probably went totally wrong in the last few weeks. But coming to your question, my sense is that one should start looking at pockets which are relatively de-risked. One such stock which I have a small position in is a DV's lab, for instance. From my point of view, I've done reasonably good amount of reading and research on it, and I think it's a safe bet. Of course, I'm not advocating the stock, but similarly like this, if one is knowledgeable enough, which I am not actually, but whatever little I could get a hang of, if you're knowledgeable enough and if you read enough, you should go and buy individual stocks. But I would actually prefer and advise investors to actually go and buy a sector specific exposure right now. Go and look at a pharma fund, put in some money in there, because the fund managers there are sensibly reallocating, allocating and shuffling things, because they are obviously a specialist there. So if you want to take a pharma exposure right now and are not too sure whether the cycle is turning or you're closer to the bottom, the only and the best bet right now, in my opinion, would be to go and buy a pharma fund if you do want to have an allocation to the portfolio, because it's very difficult to game individual companies. Like I said, I myself went wrong 2 months back, and it's been a bad call.
DVs, or are you still holding on to DVs?
I'm holding on to?
Are you holding on to DVs? Are you averaging out your position?
Oh yes, I'm holding on to DVs because I entered at a low price. So I'm not really losing money in there. I'm still got a substantially good return there in a short period of time. But like I said, I'm as confused about all the companies, because you certainly don't know what pops up from where. So therefore, even if I was to allocate a substantial amount of money, I would just wisely go to a good fund manager who's managing a sector specific fund and put money in there. Because it's really becoming impossible to game there, and the sector is very complex, whether it's got to do with approvals, whether it's got to do with the generics, or which country, what geography the company is exposed to, where what pops up. So it's something that I once again would like to repeat: just stick to a pharma specific fund.
Sanjay, IT you don't believe has come anywhere close to that bottom fishing zone?
Yeah, IT, I've maintained that for a while, and I still maintain it, that quality exposure like an Infosys, like a Wipro, this is a time to nibble at them, to keep adding them to the portfolio. a lot of them are refocusing and reorienting their model, whether it's workforce skill set, whether it's geographies, whether it's execution profiles of what they're wanting to do, which segments they're working in. So they're all refocusing themselves. This period is painful for everyone when managements have to do this. But if you're willing to go through this pain for I would not say pain, if you're willing to go through this patience of riding this flat movement or a mildly volatile movement, this is a good time to slowly start building some IT positions. And I would advise investors to stick to the quality 2-3 names where you have conviction. And if you spell something going wrong in there, because the problem here is also got to do, it's a total people oriented business. So if for instance someone like a Vishal Sikka decides to quit Infosys, that would be a cause for me to jump out of my seat and run. So this kind of a stuff you need to keep a watch on, but otherwise I think it's a good time to start building a portfolio there.
The important flash that HDFC Bank has also cut saving rates on deposits below 50 lakh rupees to 3.5%. So now if you are actually parking money in savings, which a lot of savers still do, you're actually getting a rate which is even lower than inflation. So actually putting money in savings, it was never a great proposition, but now the return has come down to an historic low of about 3.5%. And Sanjay, frankly, for the longest time I've argued on the channel that find me a billionaire who's become rich by putting money in savings. I mean, it is important to take some risk, because if you don't take risk right now, I mean, you are missing on the great opportunity.
I totally agree with you, Nikunjan. I think it's very important for investors to understand that the only option left today is, kind of evaluate your risk profile and allocate a reasonably good amount of portion to equities and particularly to mutual funds, both a combination of balanced debt and pure plain vanilla equity. There is no option right now. There is no other saving instrument which provides you liquidity, good return over a long period of time, and obviously you're not sitting on dead money in your savings account with a balance of 1 lakh or 10 lakhs or 50,000 rupees. Put basically 3-6 months of money that you need. I'm really actually talking elementary today so that people understand. Put 3-6 months of money that you think you need and leave that in a savings account or a short-term deposit account which you can encash. But rest of the money keep deploying into the equity markets and never come in whole hog suddenly when there's euphoria and there's party talk in the evening that now markets in a bull market, blah blah blah. But keep allocating money to the markets as you see an opportunity. If you haven't done any SIPs till now, SIPs till now, doesn't matter. When you have money, put it in the market. When market falls, try and put some more. It doesn't matter. But always remember that it's there for 2, 3, 5 years. It's not there for 2 months, 3 months or 6 months. And just absolutely stay away from the futures and options market or any kind of short-term trading which we all get lured into because of tips that are floating around. So to cut a long story short, savings money, obviously savings bank is the most unviable or the most useless option right now because not even be matching the inflation rate. And demonetization has led to most of these issues because a large amount of money that's come into the banking system because of that is now lying idle. So banks are having to cut down, their CASA has become huge, lending is not picking up. So a combination of all these is making the banks do all this.
Yes, always great chatting with you, Sanjay. Let you go on that note. And today was really that back to basics kind of discussion with you, but it's much needed sometimes.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/ETNow.